right. Test 1, 2. Good afternoon, everyone, and thanks so much for joining us and for bearing with us through the technical difficulty. My name is Marian Hensley. I'm the Vice President of Media Operations here at FreightWaves, and we are excited to present this webinar in partnership with DDC FPO, the #1 preferred back office partner for transportation, now offering international shipment processing. To learn more about this, freight billing, and with AI and other solutions, visit ddcfpo.com or email info@ddcfpo.com for more details. I'm excited to be here today with our very own Zach Strickland and Anthony Smith, who are going to be providing you guys with the latest details on what is happening in the freight markets, particularly as it relates to everything that we're dealing with, the coronavirus. Guys, welcome.
Hello.
Thanks for having us.
So not much going on lately, huh?
No, it's been a pretty quiet month.
As Marianne mentioned, you have, this is Anthony Smith. I am the lead economist here at FreightWaves, and my partner in crime here, Zach Strickland, is the freight guru, the Sultan of Sonar, if you will. Really the director of freight intelligence, and really heads up a lot of our deep insights into really almost every segment of our freight platform. And that's really what we're all about is, for those of you who have not joined us before, we are a band of individuals that have deep tribal knowledge in certain industries and different areas of expertise. And we bring it all together using world-class data sets to really kind of tie that tribal knowledge with some actual real-world data that's near real time and really hard to match anywhere else, Zach.
Yeah, no, I mean, the whole point is you can have all the data that you want if you don't know how to read it. If you go over and you try to learn Greek in one day, you're probably going to fail. So that's what we're here for. We're trying to tie the data together with that real world experience and also interpretation so that you guys can have the most actionable information possible at your fingertips. So that being said, Anthony, I think I'm going to let you kick things off. We're going to do things, for those of you that have joined us before, we've typically had an economic section followed by a freight market update section. We're going to have a little bit more of an community effort here today because we are in a unique environment with the coronavirus, COVID-19, whatever you want to call it. The world is changing pretty rapidly. I know just 2 weeks ago, everybody was driving into work, doing their normal day-to-day routine, and now most of the population, especially in the larger cities, is now isolated indoors. That has had a dramatic impact to the world we live in, how the economy is moving, how the freight market is moving, how all businesses are operating right now. So, I think that requires us to be a little bit more interactive and interchanged with the information. This is not simply an event that's going to dissipate overnight. But it's also going to be an event that we're going to have to really be cognizant of, that it's going to change every single day, and it's going to be pretty live here for the next several weeks to several months.
That's exactly right. Zach, I remember last month we were talking about quite a few different things of what to expect, indicators to watch. We have, so as many of you know, macro data sets, those of you who track macroeconomic data sets, a lot of those data sets are still reflecting February numbers, and that might be fine and well for typical months and typical webinars, but a lot of times, now we're in a place where things are changing on a week-to-week basis, on a day-to-day basis, really, as things develop and really we find situations varying from region to region throughout the nation. So just kicking things off here, we're going to, look at one of the most impactful segments of the economy, and this is going to be surrounding consumer conditions. One of the areas I remember last month that we went over that we're going to watch closely is weekly jobless claims. We just had unemployment numbers come out again for February, showing a 3.5% unemployment rate, but that's a bit obsolete at this point. So when we're looking at really an expectation of what we can really see real world conditions, we're going to look at weekly jobless claims. And so what this is it's a culmination of regional estimates around unemployment benefits for individuals that are applying for these. And so it's an estimate that's put out by the Labor Department. And so what we can see is this is typically volatile on a week-to-week basis. So usually individuals look at a 4-week moving average, but I think now more than ever that week-to-week movement is going to be more impactful than ever. In the latest week, we saw that there was a 70,000 applicant jump to 281,000 individuals for weekly jobless claims. And so this is a number that's released every Thursday, Zach, and this over 1 week, this is already the highest number we've seen since September 2017.
Yeah, and to your point, I mean, this is probably the key economic indicator here for the near term, because it is a weekly number that we're looking at. This is probably going to be the single most impactful number that we watch here over the next several months. As you know, the economy has kind of been, everybody's forced to stay indoors. They can't go to their jobs. You know, restaurants, service industry stuff is really forced to take a look at its numbers. You know, businesses are laying off people at the highest rate that you've probably ever seen. Correct, Anthony?
Yeah. This is it's extremely fast. But what we'll see here coming up shortly is like this is just the tip of the iceberg right now. This is a pretty drastic jump. But really, it's just the beginning. And so to your point, since this is just the beginning, I know we've heard a lot of reports over the last couple of weeks about estimated unemployment numbers. You know, we had young Andrew Cox write an article for those Sonar subscribers over the last weekend talking about how the 20% unemployment rate is possible. I think it's important that we talk to that point, like how rapidly do you see this number jumping? I mean, we're hearing 3.5 million next week, potentially, which, I mean, statistically speaking, this is not something that should happen really unless an asteroid were to come flying into the Earth, you know, every 600 million years. It's statistically like not something that should happen, but it is potentially happening. So speak to the point about what do you see here over the next few weeks? Yeah, I think over the next few weeks, we're definitely going to see a continuous ramp up in unemployment. That 20% unemployment number that's been thrown around, I think that's a very aggressive number. I don't think we'll get to that level. Even though things are getting really rough for a lot of individuals, I think we might be even hard pressed to see anything too much over the double digits level, around 10 to 11%. And I know many institutions might see that as overly conservative, but that's the thing. It's just so many, it's a wide variance of expectations through a lot of outlets right now. But I do see that when we're looking at certain segments, especially hospitality, those in potential transportation works like flight attendants and things like that, airlines, those that are more exposed to on the service side that can't work remotely and can't just kind of shelter in place and really kind of still get that same production out. Those are going to be the workless claims that are going to be really, really impactful. So I think in the coming months, that's going to be really the telltale sign of how rapidly unemployment rates are going to rise. Thankfully, I heard we just got a stimulus package that kind of came through. So there's going to be a lot of, I think, speculation around it, especially diving into some of the details, seeing how much support there is going to be for small businesses, because that's going to be crucial, and making sure that the stimulus is going to be, given over to those that are looking to retain their employees and really maintaining their workforce and not just laying everyone off. And so I think that's going to be the critical point. That's going to be the pivotal thing that this all is keeping those who aren't able to work remotely employed for the time being while we're going through this pandemic situation.
Yeah, and then, the employment figures are important in the way that it does impact consumer sentiment, your feelings that you like to talk about,
right,
and also consumer spending. And, I think here in the near term, we're not going to see this represented as clearly. I think what we're seeing in the freight market right now is a large amount of consumer goods, consumer products being pushed through the freight networks as, you have your Walmarts, and your grocery stores and your dollar stores really, having to replenish their store inventories rapidly. That's depleting DC inventories rapidly. I'll hit on that here in a little while. But, the big story of the first couple of weeks of this outbreak and everybody's shelter at home scenario is the fact that we are seeing rapid amounts of spending on these consumer products. You have obviously the toilet paper that has somehow taken over. We're not going to get into the psychology of that, but at the same time, it's a real thing. You go to the store, you see, something is in short supply. You may have enough for the next week or two, but you go ahead and get it anyway, just to make sure that you have it. That's a real thing. So, when you're looking at the freight market itself, this is, as long as you see those store shelves empty, there's going to be goods flowing through the system.
Right. And that's a big thing here. Especially talks to the slide I have up now with the sonar chart with weekly jobless claims, of course, and that yellow line, and retail sales updated through February. Again, a bit dated now that we're here in March and things
It's funny how almost like it seems like a year ago that it was February.
Exactly. And so things were so much different in February. And so what we can see is that there's a reasonable correlation or inverse relationship between weekly jobless claims and retail sales. And so when jobless claims are high, more individuals are filing for unemployment. Retail sales decline, understandably, because individuals have less expendable income. And so because of that, the last spike we saw was in, of course, 2008, 2009. And we've been pretty steadily declining since. And so if we see that overt spike that many are anticipating, that's also going to correlate to a reduction in a lot of retail sales. Also, the other aspect is that we're in a time where only essential businesses are operating. So we have, traditional department stores, malls, even though they were on their way out, really shuttering all operations altogether. And so there's going to be a decline expectedly for, of course, these brick and mortar stores that were already kind of on their way out, so to speak, and really kind of going by the way of e-commerce, really struggling. And really that's going to be an area of over decline expectedly in the March results. On the other side, expecting some strong grocery store numbers here for retail sales in the coming weeks when we get that March update. Also expecting to see, I think in March we're going to see consistent rise or more increase in e-commerce, so non-store retailers, Amazon and e-commerce giants like that. I think they're going to have expectedly a lot more traffic now that individuals are, I think, practicing more and more social distancing, ordering goods instead of going out and leaving the house. So I think we're going to see some, of course, rise there. But overall, that's not going to be, I think, enough to really kind of support month-to-month growth for retail sales. Of course, there's going to likely be significant contraction when we're looking at the second quarter overall. With everything happening now. But when we're looking at the retail segment and those consumer conditions, those are going to be definite areas to watch, especially weekly jobs claims, and really how impactful and how soon some of the stimulus can get into the hands of those that need it the most.
Yeah, I think the key here also is that we're going to see, I think you touched on it a little bit. We're going to see a different world when we come out of this. This is going to pass. The coronavirus will get, mitigated to some level. We'll all start going back to our lives in general, and there's going to be a different environment when we come out of this. A lot of what's happening right now is something that's actually going to speed up a process that we were already talking about in the previous months. And that's the fact of what you just said with retail stores, these big box stores, maybe these old models that were kind of already on their way out We're now speeding up that process of cleaning out some of the weaker segments of the economy, these weaker models that probably maybe just were there because they were, just existing and rooted in long-standing, just because they had been around for so long. We're going to see that probably shift really quickly coming out of this. We're going to see a lot more dependence on e-commerce, a lot more growth in that e-grocery segment that we saw before. The food service thing is very interesting to me because you have your food services, your Sysco's that were reported, of course, to have laid off a significant amount of people, but they've also changed their supply chain up a little bit in order to utilize their capacity for more grocery warehousing utilization versus the traditional restaurant model. So again, how much that trades off here in the long run, or I should say in the midterm. I think these next 2 to 3 months are probably very much dependent on that grocery e-warehouse type situation. The restaurant model will come back, obviously. Once everybody gets out of their houses, they are going to be starving, literally, to get into, some form of normalcy and regular restauranting and going out to eat and stuff like that. So that will come back, but it still looks like here in the near term, we're going to see not quite the even transition from food services such as restaurants and that traditional model that Sysco was servicing. It's going to be a lot of eat in the house, eat at home, make your own food type model. Right.
Yeah. I mean, then you have probably more so reckless individuals like myself that are still, depending on delivery and Uber Eats and Postmates and all that stuff. And so I probably need to, really kind of ramp up my eat at home practices. I think one of the things that you definitely touched on, I think, is the expectations of businesses, the landscape of everything that after this, because, we've had, brick and mortar stores really struggling for the most part. This is going to be a time where I think we chatted about it early on. During these downturns, a lot of innovations are made, and really this is going to force a lot of hands, whether they like it or not, to really kind of adapt and really, if they want to thrive and really kind of see the other side of this whole thing, to really be able to adapt to the e-commerce world and really service consumers in this new this pandemic. And so I think the other thing that's going to be really interesting to see, Zach, as you mentioned earlier, I am all about sentiment, consumer confidence, and feelings.
All those feelings.
And so, I couldn't have gone this long without mentioning it. So, of course, consumer confidence is going to take some sort of a hit. That's a given. But what I'm interested in is if that's going to be long lasting or not, and if that consumer confidence is going to outlive the pandemic itself. I'm sure it is for many individuals. When perhaps, this entire coronavirus clears over, is that fear, that sentiment that there's an outbreak, a pandemic going to outlast the actual pandemic itself, and are individuals going to remain home and continue to practice social distancing even afterwards, when we see we're on the other end of this thing.
So the industrial economy, Anthony, it wasn't doing great to begin with.
No.
This is the thing that, it's kind of that underlying thing, and I'm going to touch on this a little bit later, that probably is going to take a pretty big hit in all this mess, correct?
Correct. And so this was an area that was struggling in 2019 for much of the latter half. I think probably for a good 5 out of the 12 months, it was in significant decline. And so when we're looking at industrial production, almost comically, there was an increase in February. And
things were starting to ramp up. They were actually kind of...
Yeah, there was a little bit of a ramp up, and just before a ramp up in coronavirus, infections throughout March. And so this is going to be, I think, one of the most impacted segments within the economy. Of course, factories shutting down, workers not being able to, work remotely. So this is going to be a complete and a complete shutdown for manufacturing, a complete
Except for certain segments, correct? I mean, there's going to be essential segments. I think we're going to see the medical supplies obviously ramp up a lot. I think the Ford plant has repurposed some segments to create masks and ventilators or something like that. So I it's just like wartime and, World War II, where they changed a lot of these factories into productive spaces. Right. Well, they weren't able to really make their traditional items. So we're not going to see a complete bottoming out, correct?
We won't see a complete bottoming out, but I think when we're looking at the segments that are still operating, it won't be enough to really support overall growth. So the thing is, Zach, as I mentioned earlier, this is through February. Doesn't really give you much of an outlook. So one of the things that I would suggest, those of you who maybe are interested still in different parts of the manufacturing economy and looking for a little bit more real-time look, just a quick reminder that there are regional surveys done that's put out by the Fed. So I'm going to go over a couple briefly here. Right now on the screen, I have the Philadelphia Fed Manufacturing Index. And so this is a data point that shows, it's probably one of the earliest data points between this and the next one I'm going to pull up here. Is one of the earliest data points that shows the true impacts that's going to be hitting manufacturing. And so this is a diffusion index. So of course it kind of gauges businesses that are really all throughout manufacturing. So it doesn't really tackle one specific market or industry within manufacturing as manufacturing as a whole. So business owners and businesses within the Philadelphia region are expecting current business conditions to really be dire and have dire current business conditions and expect them to be pretty harsh in the coming months. And so really the reading for this, anything below 0 is indicative of expectations of contraction or present contraction. So what we saw was there was a reading of 36.7 in February, and now it's a negative 12.7. So a pretty substantial decline. And this is
probably one of the quickest indicators of what the impact of the coronavirus is having, correct?
Correct. And again, this is, so I have this one, the Philly Fed Index, and the next one I have, of course, the Empire State. So looking at the New York region, but there are, I'm not going to go down the entire list, but there is also I think there's a Kansas, Dallas, there's a few for the West Coast, more in the Southeast. So there are quite a few regional Fed surveys that might be a little bit more pertinent to all of you all that are listening in on the call, that you might want to see what's the current sentiment around current business conditions and future outlook. And it has different components, again, like new orders, production, employment, all that other stuff. So again, New York is going to be one of the hardest hit areas throughout the country. This doesn't go for just manufacturing, but overall, I mean, I think it's been noted that New York is now the epicenter
in the United States for the outbreak. So the range here isn't like other diffusion indexes from 0 to 100, correct?
No, so anything below 0.
Yeah, so it's negative 50 to positive 50.
Right.
Just so everybody has that in their head.
Yeah, and so this is going to be, New York. Zach, we're still able to kind of operate here in Chattanooga, Tennessee, and kind of get by day to day. But I think when we're looking at the impacts of the coronavirus on a regional level, there's definitely going to be some harder hit areas than others in the country, especially when you're looking at high populated metropolitan areas and coastal cities. I think those are definitely going to be a little bit more impacted than others, especially when you're looking at business activity and ability to really operate on a day-to-day.
And that's really important to note. I mean, especially for those operating in freight and transportation. A lot of carrier networks are based on certain exposures to certain regions, especially shippers. So these types of data points are really crucial in understanding the volatility of a region, the viability of a region, how well it's weathering the storm on the industrial side for sure. Right. If you are operating heavy in the Northeast, you really need to know what's going on in New York. You need to know what's going on up there. So to see, if a certain region, we all know that things are going to probably go down here in the next couple of months. But also, just like we're watching for things to kind of slow down in the freight market, it's more going to be just as important to watch them go back up, because I think anybody that's done any statistical modeling knows that volatility tends to be, kind of like, for every reaction, there's an equal and opposite reaction. And anybody that's done one of those pendulum things on the desks, you set one super far back and it's going to knock the one on the other end all the way to the other side until slowly it starts to come back down.
Right.
If you start that pendulum really short, distance from the rest of those little balls, it's not going to take as long and it's going to be a little bit more smooth.
Yeah.
This is a dramatic, whoever pulled that pendulum. Test. Test. Hello. Can I get some confirmation if anybody can hear me?
All right, all right. Well, while Anthony's getting reset up here, I'm going to go ahead and progress through because I shouldn't be talking about Anthony's slides. Hopefully everybody's doing all right out there. Thanks for bearing with us through the technical difficulties. Let's go ahead and start on this freight market. All right. So, about what's gone on since the coronavirus kicked off was the freight volumes. The freight volumes turned up March 2nd. We saw a dramatic spike in tender volumes. If anybody's familiar with some FreightWaves, we have the outbound tender volume index, the rejection index. These are electronically loads that come across from shippers, and we made an index out of it. And the base value was 2,000 on March 1st, 2018. So what you're looking at there is value of 12,776. So that means we are roughly 27.7% higher than we were on that create date of March 1st, 2018. If you look at those two other lines on the slide here, you can see one in green and one in yellow. The green one is going to be 2018 levels, and the yellow is going to be last year's levels, so 2019. And the big deal to see here is that we are dramatically above both. 2018 considered one of the most robust freight markets in the recent decades, and now we are 24% above that. So again, the rise itself is what's been so important here. And all those consumer goods, we had a large amount of inventory pulled into the United States last year with the trade war and all of its impact. Then we had a lot of freight prior to Chinese New Year, which occurred on January 25th this year. So effectively, we were set up to have, probably peak inventory levels prior to this outbreak. And February, of course, was super flat. I remember talking about how there was marginal change in tender volumes last month. Well, this month is totally different. We have seen a meteoric rise over the course of the month. So volumes averaging 14.7% higher than last year, and as much as 30% higher at times versus last year. The previous peak of the outbound tender volume index since its creation in March of 2018 was 11,068 in June, and that is 16% lower than the current level. So for the first time since this outbreak occurred, we just today have noticed that we are seeing a sequential decline in daily outbound tender volume index. So this may be the crest, something that we were all waiting for, since it has been a 22-day increase, sequential increase. Now we are seeing our first day of decrease. It could go up. One day is not a trend. It could go back up. We could start to see things, filling back up again, but it's doubtful here in the near term because essentially of what we said, there's, the economic downturn is real and the numbers may not be coming out yet, but a lot of what Anthony was talking about, those diffusion indexes, starting to show up in some of those economic indicators. So that said, it simply cannot last at this level, even in an extremely volatile period of time. So volumes really, hitting their stride. So what does that mean in terms of, van and reefer? So everyone's expecting it to be largely reefer. Well, yes, a lot of reefer activity did occur, but it occurred slower than the dry van goods. So the dry van tender volume index, which you have there in the blue, it started showing up in early March. It took reefer, even though reefer did increase a little bit in the early part of March, it didn't really get going until the middle of March, and then it spiked significantly. So the increase was a lot more rapid in reefer volumes versus van. Again, if you look at the rates of increase here, they are phenomenal. You cannot. There's no forecast. There's no budget that could have called for this in terms of just overall activity. Reefer volumes skyrocketed 61% in 13 days. That is, capacity simply cannot respond quickly enough to that. Van volumes 24% over 24 days. But again, that's a larger number to start with, so that's going to be actually more in terms of absolute value versus reefer, which is roughly around 15 to 20% of the overall data reflected in the tender volume index. So what that means in terms of overall markets. I think the importance of this slide here is basically to show you that it's not just happening in one market or four markets. What you're looking at is a tree map of all the 135 markets in the United States. 124 out of the 135 are up month over month. 92% of the markets increased this month versus, last month where, you see about a 50-50 on a flat month. But they're marginally up, marginally down. Look at some of these numbers: 32.8% increase out of Atlanta, Georgia. Harrisburg, 55% up. Now, Harrisburg, of course, having a lot of presence in the Northeast. A lot of that volume goes into the megalopolis, so the northeastern volumes are a lot of short-haul volumes there. Think about them as regional hubs. Lakeland, Florida, a big grocery presence in Lakeland, 74% up. Month over month. So these are tremendous increases. If you look at some of the down markets, you're looking at Detroit there, heavy automotive presence there, so it does make sense that down cycles. I looked at a few of these other markets. They're not necessarily, necessarily down that much. It's just that they had some pretty big spikes at the end of February that make that number look like it's not as good as it was. But most of these markets, I think you're going to see a pretty even trend here, that everywhere across the country up in terms of freight volume. And a lot of that's going to be dependent on, what type of freight that is. Most of this stuff is going to be consumer goods. So I think some of the numbers and estimates that we've been looking at show that consumer products represent roughly 40% of the transportation market in general. On any given month, this time around, we're looking at roughly 60% just because of the surge in volume. So that to overcome, the decline in the airlines, the Boeings, the GMs, and the automotive sector, and some of that industrial manufacturing, consumer products simply have to take over more of that market share in terms of volume. So what you're looking at here is kind of reflective of what we've seen. So a lot of short-haul volume growth, but if you look, you have to kind of pay attention to the detail here. Over the long run, short-haul volumes, local volumes really growing. That local volume number, then the 0 to 99-mile length of haul, you can see that it was growing pretty fast at first and now has started to trickle out. That's a sign that a lot of these DCs and warehouses are running out of inventory, et cetera. So that means that they are not going to have as much freight available. So we're starting to see that kind of die out. But if you look at that long-haul volume down there in the yellow, that's actually starting to increase along with the tweener volume. Now, that's going to be loads moving over 450 and 800 miles, respectively. So that tweener freight, 450 to 800 miles, long-haul freight, 801 miles plus, that's starting to increase. That's a sign that a lot of the freight is starting to move across the country to replenish some of these local warehouses and regional warehouses. This is an important sign to look at, especially as you're looking at cities like New York, Harrisburg, et cetera, which have a huge presence in terms of just a population that needs a lot of near-term freight. They like their just-in-time. So what has that done to capacity? I overlaid our outbound tender rejection index, which again, for those of you that aren't familiar with this is an index. It's basically a rate at which carriers are rejecting their load requests. So if a shipper sends over 10 loads, carriers reject 2 of those loads, that's a 20% rejection rate. Carriers typically operate on a soft year in that 95 to 98 percentile acceptance rate, which would be a 5 to 2% rejection rate. Which is something we saw in February. I think we were hovering right around 5.5% rejections in February. This month, we have broken through seasonal peak last year by a large margin. We have not seen this level of tightness in the market in general since 2018, when we were coming out of that very robust market. So, yeah, rejection rates up there around 18.2% right now. That's a very high number, and the rate at which the market destabilized was even more impressive. It took a while for it to break through that Christmas peak. Now, this time of year is a little different. 18% means a lot more in March than it does in December, simply because of the fact a lot of drivers, a lot of carriers are going offline. They're going on vacations. If you see that outbound tender volume index there in the orange line, it's not necessarily a direct relationship with tender rejections, which is what a lot of people equate to capacity tightness is volume increases, capacity tightens. That's absolutely the case in March. That's not necessarily the case in December and Thanksgiving, when the holiday pulls a lot of drivers offline. So you see there, the outbound tender volume index actually falls throughout the month of December, whereas rejection rates increase. That's because the supply side is more impacted than the demand side during that period of time. And again, a lot shorter haul freight, which does not have as much impact to capacity overall. Right now, we're seeing increase in short haul freight, but also increase in long haul freight and an extreme surge of demand at all levels in this market. So looking at outbound tender rejection index for the United States, the entire country, save for Missoula and Albuquerque, have had a month-over-month increase in rejection rates, which means that the entire country went tight this month simultaneously. Of course, Albuquerque, Missoula, not super large in terms of volume, so the volatility there is pretty high in general, so we might just be hitting a moment where we were just slightly underneath what we saw at late February, which, again, traditional for low volume markets with high volatility. Not that surprising, but it is impressive to see 133 of the 135 markets all saw tender rejection rate increases. That has never happened before, month over month. So largest markets in the country still showing extreme tightness. Chicago, Atlanta, Los Angeles, Dallas, Harrisburg, Philadelphia markets showing tightness. The Los Angeles market has started to show a little bit of weak. All of them have slowed down volume-wise to an extent. Some of these inland markets, of course, showing up a little bit later than these larger metropolitan markets are in terms of volume increasing, tightness, et cetera. It's kind of taken a minute to suck a lot of the capacity out of these smaller markets, and it pulls them into the Atlantas, the Los Angeleses, and whatnot. So right now, all of those outbound tender rejection indexes are up in these bigger markets. Rail volumes. So rail, of course, it's not necessarily something we expect to see this time of year with a lot of rail volumes, but we are using the rail volumes, especially the international loaded rail container volumes, to show us what kind of import activity is flowing through the United States right now. That's why I have O-Rail International loaded. So these are the international 20, 40, 45-foot containers. They come in off the ships, maritime, hit the ports, get transloaded onto a drayage, then they go into warehouses. It may take them a while to get into a truck, a 53-footer, which you see there on the domestic, which is the domestic rail car loaded volumes in the United States, showing up on the green line there. That's the 53-footers, 48-foot containers moving on the rail. You see in November, we actually had a bigger decrease on the rail for 53-footers than we saw, here recently. That's because we saw a lot of decline in import volumes due to the trade war. Talked about this last month. The trade war actually had a bigger impact to domestic volumes on the 53-foot intermodal side than anything, or than the coronavirus. So that continues to be the case as 53-footers stay a little bit more resilient, and at least domestically. And then we see these, if you look at that little dip there at the end on the blue line for your international loaded containers, it looks like we may have bottomed out, at least for the time being, on the rail side for international containers, which is a good sign, which means that China may be able to send more volume our way. Speaking of maritime, going into the section where we saw, I've got a line there going from Chinese New Year impact last year to the Chinese New Year impact this year. You can see that we are dramatically down in terms of shipment volume. Clearing customs in the United States, we're down 20% versus last year's bottom. The difference is that we are staying down longer than we would have if simply we didn't have a coronavirus. Obviously, we had a little bit harder bottom as well, but the coronavirus is also keeping those volumes down, especially on the shipment count. The good news is again, we are seeing a slight recovery on that aspect currently, but it's not, the pace that we're seeing this increase is not enough to replenish those warehouses. So imports and rail, we overlay those. I targeted China, the United States in this chart, as well as outbound rail volumes. Los Angeles, again, one of the easiest ports to see a relationship between imports and overall freight volumes. Los Angeles volumes did have a bounce there for a little bit, but they've retracted a little bit. Now, the problem with some of this data is the fact that we cannot see how tightly packed these shipments are. They could be 5 20-foot containers, or they could be 1 20-foot container. We're not really sure with this particular data set. So we could be seeing a little bit more freight, coming across in bulk. So those volume orders, those volume shipments are probably helping boost those rail volumes that you see there coming out of Los Angeles. Now, we do see a little bit of a temporary decline here, but the good news is that it looks like, at least on the Chinese import front, we have bottomed for the time being. And last but not least, the fuel market. So oil it's kind of a dichotomy here in terms of the relationship with fuel and transportation. On one hand, fuel is one of the biggest costs of a transportation provider. As fuel rates go up, obviously that's a bigger cost to the carrier. Therefore, it compresses their margins when it's moving up rapidly. When it stabilizes, it's more manageable of a cost because they can pass that along to their customer. Well, what we're seeing right now is a quick drop in that in the crude oil price, which is dragging down the ultra-low sulfur diesel price, the main primary fuel source for a lot of these carriers out there, and it's increasing the fuel spread. So this is going to aid carriers in the short term, because that means that they're going to, for those carriers that are purchasing the rack price down there in the blue line, they're going to get a little bit of benefit, because that retail price is going to be, which is where most carriers' fuel surcharges are based off of, it's going to be a lot more reactive and move a lot faster than that retail price. The retail price moves slowly. It's a weekly number that a lot of carriers deal with, and you can see right there it's dragging compared to the rack price, which is the wholesale price of diesel. Now, the problem with this is when oil prices are going down, that also has a compounding impact to the industrial economy. This is not a good sign moving forward into the later part of 2020. As we see, industrial production may not be supported to this. The United States is now a large producer of crude oil in the world, and Saudi Arabia has really ramped up its production, discounting, its prices in the world market, which is really not a good sign for domestic oil producers. They'll probably start shutting down oil wells across the country. So that'll wrap it up for my section and the speedy version that we had to do because of some technical difficulties. So thanks to everybody that was that bared with us through some of that. Obviously, maybe the internet got flooded with everybody working from home and all the coronavirus stay-at-home stuff. So that's good news on that front. But to summarize things, Anthony, I think, give us a quick rundown of what you think this whole situation is here in the near term.
Restaurants, things like that, they're going to be affected. In order to try to really keep the economy, so you're going to be job like that. Those are able to do those that are still, really equal support.
Well,
hello, am I back on?
Yep.
Excellent. Sorry. Just a myriad of technical difficulties. I think those individuals that are going to be supported are going to be, it's going to be really the biggest point to support those, and of course the small businesses throughout the country that are employing these individuals to kind of keep them on payroll. And I think with the current stimulus package and the way things are set up, it should be, I think, more or less expensive to support these small businesses than to go the unemployment route and have to pay out any kind of Medicare expenses and things like that. So looking at it, I'm really seems like there is some optimism here with the new stimulus package that's been reached. Hopefully it can hit those who need it the most soon and really do something to really help support those consumers.
Yeah, and on the freight side, obviously we just hit one of the tightest, most rapidly expanding markets in recent history. It's not going to last. We're about to go through a very volatile time probably the most volatile time in anybody on this call's memory. The more rapid the rise, the harder the fall. We're probably about to go through some quick contraction. I bet our next webinar here in April will be covering the rapid decline in freight volumes and the loosening of capacity. Now, what that looks like here in 3 to 6 months, I don't think either of us are qualified or have enough data to really point to what that looks like. The stimulus package, not a lot of details there, but it should have a mitigating impact just by the sheer volume and the amount of money that's being pushed through. Should help retain some of these employees, help us recover a little bit quicker than we would had we allowed the economy to completely bottom out. And, these businesses that are out there shouldn't have to lay off as many people as they did before, which again, the more consumers are spending, which the consumer drives the American economy. If they can stay employed and stay engaged longer through this, we're looking at about a 6 to 8 week period of time here where we're going to see a dramatically depressed economy. As people are staying at home, there's still a lot of debate over when the economy needs to turn on. It's going to have a lagging impact to the freight market, of course, as people, are being laid off. They run out of money. They're not spending as much discretionary income. That's going to have a lasting impact through June. We are not going to see a traditional freight market this year. So any model that you're looking at from 2018, 2019, throw it in the garbage. This is going to be a very week-to-week, day-to-day event here over the next 6 to 8 months.
Absolutely. And thank you guys so much for sharing your insights. And to all of you in the audience, thank you so much for your patience. It's been a heck of a broadcast. I think the internet is trying to work from home too, but we really appreciate you guys being here and want to make sure that we take some time for your questions now. So first off, as you proceed through this, how will the stimulus package influence the perceptions you are sharing?
I'll let you go first, Anthony.
Yeah, on my end, I really see the stimulus package potentially being able to support those small businesses that need to kind of keep or looking to keep these individuals that can't work remotely and really support themselves or their families afloat and being able to pay their week-to-week or monthly expenses. And so I'm expecting this to really kind of help support them and bolster them for the next few, weeks, months here. And so that's really going to be my main thing that I'll be watching for. If we can see this be successfully implemented, I think that's going to mitigate some of the potential depths that consumer confidence could see. Of course, if we're seeing that fewer and fewer individuals are applying for unemployment because they can't take advantage of stimulus package opportunities and programs for them, that's going to be another plus for the overall economy and for the consumer, especially when we're looking at the recovery side of this whole thing.
Yeah, I think that's I already kind of touched on that a little bit. I think the stimulus package, by just sheer volume, is going to be able to mitigate some of that bottoming effect. I think we'll be able to recover a lot faster. My 2021 outlook is a lot more robust at this point than it was before. Typically what you see with these, bottoming recessionary periods, we pull through it. So it's the faster that we fall, probably the faster we'll recover as well.
Awesome. Thank you, guys. And next question, how do you foresee these changes from the virus, things like sheltering at home, impacting freight rates?
So in the near term, obviously freight rates are going to expand a little bit. I've had a lot of questions over, bids and rate increases and things like that. That's going to be dependent on a lot of commodities and a lot of the network that these carriers have. You're going to see probably some areas expanding their rates and some areas, probably being very defensive. And, if I were back in my old pricing chair, I would lean towards, being a little bit more defensive than I was before, knowing that this is such a short-lived event. But at the same time, just like in 2018, you saw some of these annual cycles shorten to 3 months as the scenarios have changed so dramatically here in the last few years. I think that you are going to see much more, people going back and saying, you know what, the market's changed so dramatically since March this year, we're going to put it back out for bid. So some of these carriers may take that approach. It's something that I would have suggested on my end at my former carrier, is be like, hey, let's take what we can get in the near term. And then knowing that a lot of shippers are probably going to have to reevaluate their own circumstances internally in the long run here in the next 3 months or so. So I don't think I think you're going to see by June, you'll see the rates coming all the way down on the spot market. Some of these bids will go back out as a lot of shippers will have to reevaluate, and carriers will have to reevaluate too to this rapidly changing environment.
Awesome. Next question. While industrial production and manufacturing will take a hit, do you anticipate more onshoring and less dependency on China for supply chains once we clear the Rona hurdle? And shout out to Greg there. We enjoy the Rona reference here at FreightWaves too, but I'll let you guys take a stab at that.
Hey, Greg. So, yeah, I think when we're looking at industrial production and manufacturing, I think it already got a kick off on changes in supply chain and operations when we went through that distant trade war such a long time ago, seems like. I think that really started to change the mind of potential sourcing and more potential onshoring opportunities. So I think when we're looking from that aspect, that could be another potential possibility as things start to get ramped up a little bit more. I do think that other than looking at more onshoring or nearshoring, we might see alternate locations. I know Southeast Asia was a hotbed of activity for some time for alternate manufacturing and production opportunities. But the thing is just that China is such a massive region and cog for the manufacturing and production of a lot of materials. So there might be a slight shift, but there's just so much activity and so much production coming from China that's going to be hard to replace with one fell swoop, either with near or onshoring.
Awesome. Thanks, Anthony. And next question, can you address why there is a greater impact on coastal cities?
Yeah, so I think on coastal cities front, we're looking at regions that are going to be more negatively impacted typically because coastal cities are also hotbeds for tourism, leisure, trade, hospitality. And so those are going to be the hardest hit, I think, impacted economically on a region basis. Also, when we're looking at coastal cities that are high population, very dense in population, you're also going to start to see that they're also going to be impacted because it's going to be a high trafficked area. And so I think between looking at them really not being able to rely on their core competencies of revenue from tourism and things like that, we're also looking at high trafficked areas that might also increase difficulty for social distancing measures and really kind of ramp up potential spread.
Yeah, the coastal cities, of course, are going to be more impacted just because they're population centers. I mean, you got Los Angeles, New York, both coastal cities, also two of the largest ports in the United States. Yeah. So as China has, again, one of the 22% of the import volumes in 2019 that came into the United States, when they go offline, it has a dramatic impact to those markets. So just by that alone, it has to.
Awesome, thank you. And next question, how does the outbound tender volume deal with tender rejections? When a tender is rejected, does it create a duplicate reading in the tender volume?
The answer is yes, to an extent. There is a little bit of duplication in there, and that's on purpose. but it is mitigated. There is a limit depending on the market and the area and the signature of the tender itself. It will be reduced depending on that market share and other factors involved in that. So it's not going to, it should not be, what we found is that it's actually not a huge impact to the overall tender volume score itself. It's surprising to how few duplicated tenders there are in this environment. And again, it is captured in the rejection rate, so you can make that assumption a little bit, but it only makes about a roughly 1 to 2% difference on the overall volume.
Awesome, thank you. And next question, we're hearing that wait times at warehouses are a big issue for truck drivers. Can you talk through what you're seeing, what goes into the wait time metric, and how to interpret it?
So the wait time metric is measured off of some geofencing and obviously some of the software ELD information that we have. And basically any truck that is on duty operational inside of a certain region around any of these facilities is tagged as being waiting. It does not include the times outside of the boundaries. And once you get into the guard shack and check in, you are now considered inside of the facility and officially waiting. It does not count all that time that you are in line waiting, which is something that we have noticed has increased dramatically here over the last month. You simply cannot cram all these trucks into a certain area of the facility. Traditionally, this is not the case, except for at rail yards and some of these ports, but a lot more DCs and warehouses have seen increasing wait times just inside the boundary, but it's not really accounting for the wait times outside of it.
Perfect. And with China resuming manufacturing, do we see a surge in freight demand in the West Coast port?
Not just yet. China is slowly ramping up. We're not seeing, as I showed in my last couple of charts there, the outbound rail volume has recovered about 50% of the way there where it was before in terms of international loaded volumes, your 20s and 40s. But the customs, the import shipments only had a small or moderate recovery period, and it appears to have tailed off just a little bit. And the reports are China is not fully operational at this point. It takes about 4 to 6 weeks to pull out of Chinese New Year traditionally. We are still inside of that boundary. So we should not see a dramatic increase there for some time now. We don't expect to see full Chinese production back online until probably around June or so.
All right, great. Next question. If GDP drops 20% in the next quarter, can we expect trucking volumes to match that percentage drop?
No.
Yeah, me and Anthony are in agreement on this. For those of you that watch our Freight or listen to our Freightonomics podcast, which we do every Wednesday, GDP, of course, Anthony can speak to 70% of the overall economy, and that's a service side drop. But at the same time, Anthony, I'll let you speak to how much you think it might drop.
Yeah, so as you mentioned, so around 70% of that is going to be consumer spending on goods and services, and then within goods and services, roughly 65 to 70% of that is going to be on the services side. And so when we're looking at GDP, not necessarily the best gauge for measuring activity within the freight industry. So, of course, here at FreightWaves, we look at the goods adjusted GDP. So that's essentially looking at the GDP, but stripping out all of the service side segments. So looking at things like goods consumption, plus non-residential fixed investment and equipment, plus residential fixed investment, and looking at good exports. And so looking at all of the segments that, of course, investments in expenditures and structures and things like that. So when we're looking at GDP, it's going to be important to look at the goods side. And really that's going to be more impactful for freight, seeing as how the services side don't really move too much. But looking at the second quarter, definitely I think 20% might be on the bit of the higher side for sure. But I definitely do anticipate some overt decline that could near, double digits for sure within the second quarter. But I think when we're looking at the grand scheme of this, I think we'll probably see a bottoming in the second quarter, and we'll start to see some trends kind of start to turn around by third quarter of 2020.
Great. Thanks, Anthony. And next question, do you see an increase in the recovery of trade volume from China impacting freight volumes in 2020?
Absolutely. I mean, they will. You can see the relationship. The hard part to translate is how long it takes for imports to translate into truckload volumes, and what does that mean for truckload volumes? During the trade war, for instance, we saw that impact be about on a 2 to 3 month lag, and then all of a sudden you saw this repositioning as shippers tried to reposition their freight among their supply chain, in their warehouses, in their distribution centers in different areas of the country. And when that was happening, that took about 7 to 8 months. That lasted for about 7 to 8 months before falling off. So it's not a direct transition. That's why we like to look at a lot of those rail volume, those international containers, those 20s and 40 footers. That's the more direct impact. And then eventually that transitions into inventory, which transitions into truckload volumes domestically.
Great. And we all knew it was coming. What time frame do you predict we will be back to where we were before COVID-19?
I'm going to let Anthony go first.
Sure. I think on the economic side of things, I think we'll probably, playing this out, I think we have to look at scenarios of a best case scenario to medium case to worst case scenario. I think we're even looking at the worst case scenario. I think we would see a full recovery by at least mid-2021. I'm anticipating, economic conditions really kind of being ramped up even in the worst case scenarios. And if this lasts and the depth goes further than second quarter 2020, say it goes into a trough into third quarter, and then that contracting results transition into the fourth quarter. I think 2021, by mid-2021, you should see, I anticipate a full ramp up in economic activity overall.
Yeah, and again, I'm going to kind of hedge my response here by saying return to COVID levels as being where volatility and everything settles down, because like I said with my pendulum analogy, we're going to go through periods of expansion, contraction. There's going to be surges. There's going to be, volumes that increase, plummet. We're going to be dependent somewhat on how quickly people are returning back to work in certain industries. So that's going to have a very uneven response across the United States. I tend to agree with Anthony in terms of the recovery being into 2021 in terms of where we start to be, at least some form back to normalcy. But I do think that we will be back to a regular level, sometime this year. I think we will see volumes back up by the end of the year. I think capacity will actually be a lot more volatile, because through this whole scenario you're going to see, and again, I'm going to kind of answer this in a different way. This is not necessarily saying that the economy and volumes are going to be, all the way back, but capacity itself is going to have a big culling. And it's going to be in the form of a lot of these carriers that simply will not be able to manage this volatility. So that supply side thing that we were talking about in January, February, that we thought was going to correct slowly throughout the course of the year, is now going to go through a lot faster process. So I still anticipate a lot of rate volatility here towards the end of 2020.
All right. And next question, is it a good time to start ocean freight the ocean freight contract bidding process now and aim to complete contracting by mid-year? If not, what is the recommended period to do so? Since big box retailers lead from the front when it comes to ocean freight contracting, do you have any insights into what contracting and bid strategies the retail industry is looking for?
So neither of us are maritime experts, but it is, I think, in our conversations with our maritime expert, Henry Byers, it's definitely not the worst time to complete your bid contract if possible. Right now, you are looking at a pretty soft market, and that is anticipated to change dramatically towards the mid to end year. I know peak is still probably scheduled in September. We are not anticipating a lot of leverage getting better for shippers throughout the year. That's only going to probably get worse as time progresses. Now, I would definitely want to have my contract locked up. If you do have more specific questions in terms of what we're seeing on the retail side, certainly feel free to reach out to us. We'll get Henry to answer specifically.
Great. And you spoke about the impacts on van and reefer, but do you have any insight on the flatbed market?
So flatbed just got a big hit. COVID probably did more damage to flatbed than the other sectors combined. Reefer obviously is going to be propped up by the grocery stores and cold chain suppliers out there. Van is going to do what it's going to do. So a lot of construction activity isn't as impacted by, we haven't seen any impact to real estate. You're looking at some of those industrial output projections here over the next year. And Anthony, please chime in if you see something more specific than I have. But real estate construction is not expected to have as much of an exposure to this environment as before, except for the fact that a lot of flatbed volume does rely on oil and gas industry, which is about to go into its own little recessionary state. So the flatbed sector is probably going to get a lot looser based on that alone, even though I don't think that I've seen anything on the construction/real estate side that suggests that market is going to get much softer.
Yeah, so I think on my end, I think flatbed's definitely going to be impacted by, of course, the manufacturing side of things, of course, fewer machinery and parts being hauled throughout the country. In terms of construction, around 10% of house transactions is going to be around new builds, with the remaining 89 to 90% being existing homes. And so when we're looking at new builds, there is still a huge amount of permits that really indicate that there's a lot of activity pent up that's really looking to, go underway. The thing is like when we're looking at this construction, even if some of these homes are able to be built, the increasing conditions for work at home and social distancing and things like that could really limit the permit issuing processes for completions and some of the regulations that would be in place for certain local governments and townships and things like that. So that could impede some of the housing and construction activity. We're seeing that there's maybe a backlog on, red tape that needs to be, kind of bursted through. So when I'm looking at housing construction, I'm really going to be looking closely at how impactful are potential permits and issuings for new builds. That's going to really kind of limit overall activity.
All right. Thanks so much, Anthony. We've gone about 20 minutes over here to thank you guys for bearing with us through these technical issues. We really appreciate you being here. Thank you to Anthony and Zach for taking time out of your day to share your insights. And to those of you who have asked, we will be sending a link to both the recording and the presentation within the next 24 hours to the email you used to register for this webinar. We sincerely appreciate you being here. It's our honor and delight to share this hour with you guys each month. Stay tuned for next month's market update webinar, which you will be hearing about in the next couple of weeks. And thank you once again to our partners at DDC FPO for partnering with us to bring you guys today's presentation. We appreciate you being here and hope you'll join us again next month.